And it seems like a lot, but I will say I really have the sense that what I've learned in the last 6 months to 1 year is greater in importance and clarity than everything that we had learned in the previous 7 years or so. So that's what the focus of this webinar is today, and it's really about trying to talk about what we talk about in the boardroom and see if we can take a crack at changing that dialogue, which is so desperately needing to change, to be frank. Everyone, I think, that's been on our webinars before has seen this picture, but we do have a framework, and this is our framework. It revolves around 3 things: a financial insight model, which is really a financial model for private clubs and the private club industry that has resulted from, I would just say, a lot of hard work, a lot of data analysis, a lot of data aggregation, and a passion for learning and digging in. And that led us to the key performance indicators, of which there are now 17. We're going to focus on one of the most critical pretty intensely in this webinar. And the 17 of those, we now, I think, refer to them as the vital signs for a club. They really are indicative of a club's overall financial and, I would say, operating and membership health. No different than if we go to the doctor and we get an annual checkup. The doctor focuses on certain vital signs. These are the vital signs for clubs. And then this concept of fact-based governance, it's so important and so clear to me that there's some assumptions that have lived in the industry for quite a while, let's say hundreds of years. And the assumptions related to the dialogue that exists in the boardroom, and the assumptions, frankly, are faulty, and it puts clubs in a precarious situation, and that situation can be exacerbated, as we saw during the meltdown in 08, by economic dislocation. So all 3 of these, the financial model, the KPIs, and fact-based governance, are going to come together in this webinar today. And in the end, it's all about choices, all choices in many different vectors. I think the perspective for today's webinar is the choices of what we focus on in the club dialogue, in the club boardroom. Please feel free to ask questions as we move forward here. You don't have to hold them to the end. We're very happy to take them in the last couple of webinars I've done. We've actually had a pretty dynamic dialogue during the webinar. It's not exactly ideal. It's not like being face-to-face, but it suffices. And so I'm happy to take questions in real time. In the end, we focus on the clubs that comprise CMAA, kind of the member-owned, the higher end. There's about 4,000 clubs with golf in the United States. 3,000 or so have members in CMAA. I'm rounding. Those clubs really, and it's starts to resonate with me so clearly now that it really is a cottage industry. The club industry is a cottage industry. Best practices disseminate slowly, if at all. The processes that clubs use in terms of governance and management tend to vary from one club to the next. If you look at the bylaws of 50 different clubs, they'd all be different. If you looked at the financial statements that are reviewed monthly for 50 different clubs, they'd all be different. Those are just examples of how the cottage industry, the fragmentation, the lack of a consistent framework, a consistent approach exists in the industry. I think that cottage nature of the business is built on a foundation in terms of governance and perspective that are somewhat problematic in that there's these widely held assumptions. I'm in the middle of reading a book on the Vietnam War. It's a tremendous book. And the book has helped make me think a little bit about what we do in the industry. And it's written by David Halberstam. He's a historian, and he was a reporter at the time in Vietnam. And when you look back he looked back with 20 years after the war when he wrote the book, and with a lot of research, the whole war really was built on a couple assumptions that were probably not correct. And as a result, a lot of people died, a lot of treasure was shed, and obviously we know it's not the best chapter in the country's history. Well, I think about the club industry, and in particular a couple of assumptions that exist, frankly, that have a profound impact on what happens every day in the club industry. And I guess I would say, after studying all this data and being to so many clubs and being engaged in the dialogue, these assumptions are off the mark, and they have a profound impact on the outcome. The old one that we've always talked about, the F&B trap, that F&B is the critical issue of financially, and that it should make money, and it drives clubs' finances, which is wrong. What we call now the omnipresent debate, this just became clear to me over the last couple of months, being in a few different club boardrooms. This concept of choices versus efficiency, I realized that, and I understand why, and it's a perfectly rational thought, that sometimes board members, governors, show up at the table and they have a view of the world based on their background that comes from the efficiency angle. It's about being efficient. And I've talked recently about, if you look at the industrial spectrum, on one end of the spectrum you have commodities, and in a commodity market, the market sets the price, and if you are to succeed in that market, you have to be efficient. It's all about efficiency in a commodity market, and if you aren't efficient, you will go out of business. But on the other end of the spectrum, you have Google as an example, and Google has people at the company who think about efficiency, I'm sure, but efficiency does not drive Google's stock price further north. Google's stock price is tied to the creation of world-changing ideas. The first one was how to make a whole bunch of money off of search. Another one was how to make a whole bunch of money off of digitizing the world and putting it into a map, Google Maps. Every time I use it when I travel, which is often, every time I open Google Maps, somebody's paying Google. And then the next one, that we're all familiar with now, is this whole concept of driverless cars, and think of the effect that's going to have on the world in the next 20 to 30 years. I was in a boardroom recently in California. One of the gentlemen on the board was the CEO of AAA in the 7 western states, and I didn't realize this, but they have a car they've sponsored in Las Vegas, a driverless car that brings people on tours. Right now, every day in Las Vegas, this driverless car drives people around Vegas on tours. So this isn't fictional, science fiction anymore, this is real. But Google makes money, and Google's strategic impetus is not to be efficient, it's to create game-changing ideas. So across that industrial spectrum, this debate that occurs in clubs about whether it's about efficiency or choices that we make, strategic choices of allocation of money, of investing in amenities and services. Clubs are a lot more like Google, obviously, than they are like a commodity business, and we have to understand that. And then the third point is, which has become so apparent in the last few months here at Club Benchmarking, the focus that exists on the income statement versus the balance sheet, that's really what this webinar is about, and we're going to talk in detail about that. So I'll wait as the slides pop up to really dig into that. In the perspective of governance, in thinking of it as a process that can be learned, few points that have become clearer to us. Success requires a clear, tangible vision. Clubs, so many clubs are really victims of their past. They really move sideways at best. They're not driving forward with passion and vigor towards a vision. Successful clubs are literally driving forward to a vision 3, 4 years out, 5 years out. This is what we're going to do at this club. This is the things we're investing in. These are the things we're investing in. This is the way this club's going to look in 4 or 5 years. The discussion, the focus, the passion, the energy is on the future. A lot of clubs, I would say the vast majority, the passion, the focus, the energy is on what happened last month and how does it relate to budget versus actual. It's a backwards looking view, not a forwards looking view. Success requires a forward, future looking view. We need to have broad alignment. You know, in this governance world, a lot of clubs govern out of fear, I believe, in that we're afraid to drive the financial engine the way that is necessary to support the footprint of the club now and into the future by asking members to contribute literally from their pockets to the club money in the form of capital income. We need to have alignment on that. We need to have a set of values and a vision that align people on, and the members of a given club on, we are going to protect this asset. We are going to do what we need to invest and reinvest in this asset to make sure that it's always kept up to snuff. And that goes back to the discussion on choices versus efficiency and costs. We can choose to discuss efficiency and costs, but that doesn't drive a club forward. What drives a club forward is choosing to discuss the future. And that's the balance sheet income statement, which I said we're going to talk about in some detail. So just as a snapshot on where we are, I think the way it is, and my view is, and this is anecdotal, it's informed by experience and data, frankly, but I can't say it's a fact. But I just break the club industry into two buckets, 70% in one, 30% in another. 30% of the clubs in the country, I think, have a core that is built around alignment, that is built around we will fund what we need to in the club, and that is built around a future vision, and we are investing for the future. 70% aren't that way. So the way it is the 70%, and the way it should be is the 30%. In that 70% bucket, things are all about accounting. It's always about accounting, looking back. Accounting is about accurately reporting what's happened. The focus, the monthly focus in the boardroom. I know there's a whole bunch of people on this webinar, and I'm going to guess this resonates with most, if not all. But the monthly focus is how we did, it's looking at the income statement, it's how we did actual to budget last month. It's an operating focus. And the way it should be is it should be a vision and strategy focus. The monthly board focus or dialogue should be what's going on in our progress towards our clear future state. Where are we going to be in 4 years, 3 years, 5 years? What have we done last month? What are we doing this month and next month to get us to where we're going? It's a forward-looking discussion, not a backward-looking discussion. The 70% of clubs I refer to are living 1 year at a time. We have to change this. It does not work. It causes long-term problems, which I'm going to prove here with data. So here's an example. These are two real clubs. Carmel Country Club in Charlotte has given us for about a year now. We've been using this data, so that I think we on past webinars, for those that have been here, this might be a little bit redundant, but we've worked very closely with Carmel over the years, and Carmel is a club that I've observed. I've been there a number of times. I've observed that they've invested what I would characterize as aggressively. They always seem to be doing the next big project. There's always something driving the club forward. And over the last 8 years, 10 years, they basically reinvested in everything. The swimming pool, the tennis courts, the fitness center, the golf courses. They're a 36-hole facility. The clubhouse, they just put in a significant money into reinvigorating the whole social aspect of the club through the food and beverage program. They have 4 different restaurants in the club now. It's fantastic. I would characterize that, Carmel, as a very good proxy for the 30% of clubs that are forward-looking, focused on the future, focused on the strategy to drive the future outcome, and focused on the vision of where they will be in the future. So when we started to think about how to measure success over time in clubs, it took a while to get here, several years, but we are here. And now that we collect this data, I will say it's the most important metric of the 17 KPIs. It's the net worth over time. So every business has a value on their balance sheet that relates to stockholders' equity, owners' equity, members' equity. In the not-for-profit club world, it's called unrestricted net assets. What we've done is we've gathered now from about 250 clubs the net worth over the last 10 or 12 years. And the thesis when we started this was that Carmel was probably representative of a successful club. So in 2004, the book value, the owner's equity in Carmel was $11 million. At the end of last year, it was almost $34 million. The average annual growth of that net worth was 9%. Carmel was one of the first clubs we looked at. I looked at 3 clubs almost simultaneously, my own club, Carmel, and one other club. And they represented what I thought to be kind of the market at large. The one other club is on the right. It's a old club. I think it's basically around 1920. It's in one of the major cities in the country. It's a really nice legacy club, but I would suggest that the club over time has had what I'll call a micromanaging operating focus. It's heavily focused on profitability and F&B. It represents the 70%. I think it's a great, well, it's probably an exaggerated proxy for the 70%, but the dialogue represents what goes on at many clubs. The annual growth rate in the net worth 10 years ago on paper, that club was worth $5.25 million, and today on paper it's worth $1 million. So the annual growth rate in the value, the book value of that club over that period of time has been negative 16%. So that frames the bookends of the industry. The 250 clubs that we've gathered the data for, here they are, represented. Every line on this chart is an individual club. So out of the 250 clubs we've gathered, the thesis about Carmel is held true, and I'm sure it will until we get 1,000 clubs, it'll hold true. Carmel's average annual growth rate in value is 9%, and it's 5th out of 250 clubs. It's literally at the top of the industry, which was what we suspected when we began this process. The other club that we just looked at is actually at the bottom of the industry. So you really have the bookends there. But you can see from this chart, the big core of the industry, that dark line that we just index the value of clubs every year to 100, as you see here. And so a club that flows along that black line that goes across at the 100 level is a club where the net worth has not grown over that period of time. So those clubs are worth the same today on paper as they were 10 years ago. And about 40% of the clubs are in that bucket. So literally their value has not grown in a 10 or 12 year period. The median, so half the clubs are at 1% or less. The growth is at 1% or less. 61% of the clubs, the net worth growth has not kept up with inflation. So that in real terms, and I'll point out in a moment how important this is and how it reflects itself in the club. In real terms, the club is going backwards in terms of finances. 61% of the clubs. What net worth, how net worth increases or decreases in a club is this. The vast majority of clubs, according to our data, 82% of clubs set their operating ledger to break even. So in essence, the operating ledger will not generate any financial outcome. It'll end up at zero. So it doesn't generate any money that the club could use in the future. It consumes its operating monies in a given year. So for those 82% of clubs, the only way they can increase their net worth is this. The net worth is the bottom line profit or loss in a club, including depreciation as an expense. 82% of the clubs in the country set the operating ledger to break even, excluding depreciation. So the way clubs grow their net worth is it requires the capital income what we call net available capital, earnings before depreciation, so after covering interest on debt, that number has to be greater than depreciation for the net worth to increase. If it's less than depreciation, the net worth will decrease. So net worth growth requires incoming and or existing members to contribute capital. You have to contribute capital greater than the depreciation. And the reason this is important is here. This is a balance sheet of a typical club. It's actually a real club, doesn't matter what club. But if you look at any balance sheet, it's the financial picture of the business, in this case a club, at a certain point in time, usually the end of the year. Assets equals liabilities plus equity on a balance sheet, as we see here. And you can see in this club, the assets were $7 million. This is in thousands, $7,914,000. The liabilities was $2,805,000, and the equity was $5,109,000, which totals $7,914,000. So assets equals liabilities plus equity. Up on the left side of this slide, what we see, this is the way I would, for those who aren't ingrained in finance, it's an easy way to describe it. Assets are what we have. And I'm speaking specifically to a club. It's what the club has at this point in time. What is the money we have? Liabilities and equity are how we got that money, where it came from. Liabilities is money from others, most often banks. That's the vast majority of liabilities in the club industry. And equity is money that we got from members. It's that simple. So equity is the money the members have contributed to the club. Liabilities is the money for the most purpose banks have contributed to the club. And assets are where the money went. And when you look at the asset side of a balance sheet in a club, at the average club, 80% of the assets end up on one single line item, and that's net property, plant, and equipment. So it is the current book value, the after depreciated value of the physical property, plant, and equipment we have. The clubhouse, the furniture and fixtures in the clubhouse, the parking lot, the golf course, the athletics facilities, the pool, the fitness, the tennis, all the HVAC equipment, all the kitchen equipment, etc. It's all those physical assets. What are they worth on paper after we've accounted for their depreciation expense? So 80% of the assets in a club end up as the physical property, plant, and equipment. And so when you think about this concept, the capital income, the money from members of banks, the money we take from members of banks, 80% of it ends up in the plant, the physical plant. And that's a critical point, which I'm going to leave there for a moment. With that as the backdrop, if the equity or the value of a club is going down over time, what would be happening on the other side of the balance sheet to the property, plant, and equipment? Clearly, it will also be going down over time. So the reason the net worth over time is such an important measure is it actually reflects what the club has at any point in time. And if it's evaporating, we are not doing our job as governors, as managers, as stewards of these businesses. If the net worth is declining, how it manifests itself is the physical property, plant, and equipment is becoming more and more worn, more and more dilapidated. So then the question is, how much should net worth increase? And this isn't about how much we could sell the club for. It's not that. It's about what is our club's physical condition at any point in time. There's a few things that we think of at club benchmarking that answer this question. The first one is, if you think in terms of repair and replacement of your physical assets, there's two factors in every club. Inflation, it costs more to replace something in the future than it did to acquire it in the past. And the fact that basically every club has assets that are in place that are fully depreciated. So when you look at your depreciation expense, it's not actually characterizing all of the assets that you own, because some of the things are fully depreciated. It could be an irrigation system, it could be a roof, it could be a parking lot, but it's an asset that needs to be replaced at some point in the future. And then the third factor is what we call aspirational capital, which is what are the things that we might want to add if we're in a golf-only club and we want to put a pool in. Well, the depreciation expense at any point in time doesn't reflect that pool. So we need to generate capital over time to make sure that when we want to do something new, we have the money to do it. All that taken into a nutshell, we think the clubs need to generate about, at minimum, a 3.5% per year growth in net worth to keep up. So that means that clubs need to generate capital income that's greater than the depreciation every single year. Okay? How do you do that? And this one chart, I hope, depicts ultimately what is happening in clubs and the way we need to shift the dialogue if we are to succeed. So what we show on the blue line here is the operating result. So at the median, it's 0%. That says the average club breaks even operationally, which is the data that backs up the point I made earlier. The 25th percentile is -3, and the 75th is 4. So those 50% of clubs are basically hovering around operating break even, which is what we'd expect. The gold or yellow line shows the capital income of a club as a percentage of its operating revenue. So at the median, it's 13%. At the 75th percentile, it's 20%. So that capital income is the money now that we have to cover the depreciation expense. That's the secret sauce. You can see, by the way, the 25th percentile is 6%. And there's some clubs off to the left there, that's around the 95th percentile, that have almost no capital income right now. There are 5% of the clubs in this country, that are in a precarious situation because they have no capital income. So on the left, the 25th percentile and below, we refer to those clubs as capital starved. In the right, the clubs that are at the 75th percentile and above, we refer to those clubs as capital rich. And when you look back at the net worth data, what you see is the clubs that are going backwards, which is 60%, is basically the 50th percentile and down. They're not meeting the depreciation expenses. And the clubs that are growing net worth are the ones on the right, from the median to the right. But the ones on the upper quartile, they really have an economic engine. They have capital income that is significant enough that they can actually tangibly drive the club forward in terms of repairing and replacing the capital they need and investing in new things. Whereas the ones on the far left, the physical property, plant, and equipment is literally deteriorating in front of the members' eyes. So the point here is the money, the engine, as you can see from the relative scale, the money that drives the club forward is not operating money, it's capital. The capital ledger is how clubs succeed or fail. So in the end, in life and business, we get what we focus on. If we focus on the operating ledger, we get nothing. We get to break even. But if we ignore the capital ledger, we're going backwards. So how this all intersects with the boardroom and focusing on success for 2018 is this. The average board has 12 meetings a year and meets, I ask, every time I'm in front of a board, I ask the question, how long are your meetings? Obviously there's great variation, but 80% of the answers are 2 to 3 hours. So somewhere between 24 and 36 hours a year, the board has to govern these businesses. That's not a lot of time. Let's just use 30 in the middle. 30 hours a year to govern the business? That's not a heck of a lot of time. We sure as heck better use the time wisely and make sure we talk about the things that make a difference. So we get what we focus on. If we're just focused on the operating ledger, we won't get much. The GM and the staff who are there running the business day to day, hour to hour, week to week, they're the team that's responsible for developing, managing, and meeting the operating budget. The board, and boy, we can't overstate this enough, is responsible for managing, growing, and stewardship of the assets, as I've proven with data, 80% of which is property, plant, and equipment. The board has to assure there is adequate capital income to meet future capital needs. Clubs can't instantly raise capital funds. Clubs that, let's say, have 50-year-old irrigation systems that cost $2 to $3 million to replace, it's hard to snap your fingers and raise that money. So every board meeting, every month that goes by in a club where we don't focus on this issue is 1 month closer to a serious amount of pain because we haven't collected the necessary capital income, and that month goes away and it goes behind us and we just get further and further behind. It's a snowball. We have to begin to shift the dialogue onto what matters, and it's the capital income, it's the capital ledger. It is not the operating ledger. Just ask the question. Think about the dialogue in your club's boardroom. I've asked this question hundreds of times now. The typical answer is, if I say, what percent of the time is spent on the operating versus the capital ledger? The typical answer is 90%, 10%. We have to flip that. It's got to go the exact opposite. It's got to go 90% capital, 10% operating if we are going to make this industry healthier. It's a very easy question to answer. What do we as individuals or business owners or business stewards want our net worth to do over time? Do we want it to increase or do we want it to decrease? Obviously increase. Here's what happens in clubs, and this is the key point, and then I'll open it up for questions. What we typically are doing, back to the 90% operating, 10% capital, is we focus on the operating ledger. That's where we focus the budgeting effort. That's where we focus our monthly boardroom discussion. When we're looking at the previous month's results, we're looking at the operating ledger. We're not looking at the capital ledger. We have this approach that starts on the operating ledger and ends up on the capital ledger, and we frankly run out of time. We never discuss capital, or very rarely. So net available capital is the earnings before depreciation after covering interest on debt. It's the money at the end of any period of time that a club ends up with, the cash it generated, that it can do one of three things with. Make capital investment, pay down debt, or put money in the bank. That number has to be greater than the depreciation expense for the given period. The board needs to focus on that number. Boards need to, clubs need to. That should be the first number mentioned in a monthly meeting. If you think about the for-profit business world, it's interesting. Public companies as an example. We don't have this duality of ignoring depreciation. If a company reports its earnings, or as companies report its earnings, that's after depreciation. Businesses, for-profit businesses, are forced to deal with the fact that depreciation is a real expense. And as such, in capital-intensive industries like clubs, it becomes a primary focus of the board of the strategic evolution of the company. Is how do we generate the capital necessary to keep our capitally intensive business in shape? Clubs are capitally intensive businesses. Unfortunately, we forget that. So we think a better approach is in budgeting, in dialogue, in analysis, and tracking results against budget, is to start at the bottom, not at the top. Don't start with the operating ledger, start with the capital ledger. How much money did we generate in relation to our depreciation expense this month, this quarter, this year? How much money will we generate next year in relation to our depreciation expense? Is it adequate? What are our future capital needs? How much money do we need to generate starting today? Again, we're at the juncture of a year. This is like a New Year's resolution opportunity. How much money do we need to generate to assure that we can meet this coming year's capital needs and the capital needs 5 years out? Because clubs can't turn on a dime. They need to do this proactively, looking down the road, because you can't snap your fingers and generate capital income at any point in time. It takes time to accumulate it. It's not an easy process. But if we're sitting in the boardroom worried about the pro shop gross margin or the cost of food or the cost of beverage, we are missing entirely the whole important discussion. We're talking about pennies, not dollars and millions of dollars. This just shows one particular club. So on one chart, these are charts, standard club benchmarking charts. You can generate them in an instant. The net available capital is the blue line. The depreciation expense is the gold or yellow line. So you can't decipher what that color actually is. But there's a gap at this club. It's a 3 percentage point of that's all in relation to operating revenue. It's about a $5 million club. So 3% of that revenue, 150 grand. This club's come up 150 grand short in this particular year. So that club's net worth declined by that $150,000. So their net worth is going down. They have to figure out how to close that gap. That is the critical issue. And it's the board's responsibility, obviously working in tandem with the general manager. But the board is the only one that can generate capital income or make the decisions or the choices that relate to generating capital income. So in terms of focusing on success, looking forward to next year, you have an opportunity. Most clubs have already developed their 2018 budget. There are a few that have fiscal year ends of March or April, but most now, I think it's probably 75%, have developed their 2018 budget. Let the staff manage to it. The board's got to focus on the balance sheet and the future capital needs and the resources to meet those needs, and frankly, the future vision of the club. We have to shift from an operating focus to a vision and strategy focus. You have to start planning for the future and stop living 1 year at a time. That's where clubs get themselves into trouble. I will make an announcement. We don't often do this, but I think it's such a fundamental issue. I'm going to do it, not trying to be commercial, although this is a club benchmarking webinar, but we believe so much in this concept of planning for the future that we just made a decision, and we have acquired Club Capital Planners. I'm sure most people on the webinar know Paul Mueller. He's one of the visionaries in our industry. He has for years focused on generating capital reserve studies that reflect future capital needs of clubs. He does it in a very thorough, accurate, anyone that knows Paul knows he's a very accurate, precise man. He's now part of our team. Our team now will do capital reserve studies in the future. We're so committed to this concept, to this idea, that we think it will be a huge impact in the future of the industry. Every single club on this webinar in the industry needs a capital reserve study that is objectively managed, objectively handled, that looks out 20 years. 20 years go by very fast, and we have to start to focus on and embrace those issues on the capital ledger if we're going to meet the needs in the future. And that's why so many clubs right now have that pressure. They know that they haven't invested themselves over the historically, but it's because of the things we choose to focus on. So if you want to focus on success, go with us. Focus on the balance sheet, focus on the capital ledger. Here's an example of how a capital reserve study is so important. This shows about 200 clubs. What we are looking at is the ratio of the fully depreciated book value of property, plant, and equipment as a percentage of its original cost. So it's a reflection of how depreciated or depleted the physical plant in a club is. Everyone can do this ratio in 2 minutes off of your last year-end balance sheet. You just take net PP&E after accumulated depreciation and divide it by gross PP&E, which is what you originally paid for it. And the median for the industry is 49%. So that means that the average club has depreciated their physical plant about 50% of its way. But on the left, you see a club that's at 15%, and on the right, you see clubs that are at 75. So what do you think you would find? And I've been to both of those clubs. What do you think you would find in the club where their book value of their physical assets is 15% of the original acquisition cost? You'd find a very worn-out club. If it's 75%, you'd actually find a very shiny, new, updated, fresh club. And the industry is in the middle at 50%. It's a critical measure. The only way a club can determine what that ratio should be is to do a capital reserve study. That's the critical issue. So capital reserve studies are fundamental in understanding where we should be, understanding where we need to be in the future, and they are the first step. And by the way, what we found and what Paul finds in his travels is once a club undertakes that effort to do the study, it shifts the dialogue by its very nature, because the numbers are usually so large that boards realize we better focus on these millions of dollars and stop talking about pennies. And that study is the catalyst for the dialogue, because once you know what the need is, we're good at solving problems as humans. We shift to how we're going to get that money, and that's the right place for the dialogue. And in the end, what we've seen and what we can show with data, that the more a club invests, the greater return on investment or return on equity, and the less it invests, the lower the return. It's a momentum game. The more you invest, the more success you'll have, the more your net worth will increase. And if you try to restrict investment in clubs, the net worth goes the other way. It starts to decline. So as governors, as managers, as financial executives in these organizations, we have to grasp this concept. We have to embrace it. We got to live by it. We have to figure out where we get the money to invest in the club so that we get the ball rolling in the right direction. Net worth is increasing. Members are joining. Members are contributing to a capital. As Russ likes to say, we convince our fellow members to part with some of their own net worth and give it to the club. That's the trick. That's what governance is about. That's what boards are charged with doing. They're stewards of assets, and clubs' assets are physical property, plant, and equipment. We got to figure out how to get that money out of our fellow members' pockets. It's that simple. And with that, I hope there's some questions. I think we're right at 45 minutes, which is almost ideal for a Fast Facts webinar, Terry tells me. So, Terry, I don't know if you have any questions, but I hope you do. I'd love to take some.
I had a request for Paul's contact info, so I will distribute that after. I'll just include it. I'm going to respond directly to the person that asked it, but I'll also include information in the follow-up email that comes to you after the webinar. There'll be a link to the recording, and we'll also include that capital reserve study info since that's new. I have one person asking if you can go back one slide, Ray.
To this slide? Or this one?
Probably that one, probably the flywheel.
Okay.
So I have another person asking, hang on. She says, will balance sheet metrics be available to use within the club benchmarking platform such that we can slice these balance sheet metrics the same way we slice revenue and expense metrics? I would like to see these metrics for clubs with golf with revenue between 15 and 20 million.
The answer is yes. They, at the moment, and you know, we, like any company, we have lots of ideas and we try to act on them quickly. So we have some work to do to get the balance sheet metrics into the platform. But in the meantime, we can send you a benchmark of balance sheet metrics, and we are happy to do that. So please just note who that is. Make sure you let us know, and we will send you balance sheet metrics that you can use for your benchmarking your own club.
Definitely. We'll actually have one of the member success managers reach out to you.
Yeah, it's a great question, and it's very important, and it's taken us several years to realize that, frankly, those metrics, those are the metrics that that relate to success or lack thereof.
Okay, next question. How do you assess the risk of making significant capital improvements when you know you will see resignations initially and hope to see new members after improvements?
That is a great question, too, and I'd answer it two ways. The first one is nailing down the future capital needs. So at Club Benchmarking, we are very significant advocates of nailing the needs down and then developing the plan. What we've tended to see, I think, historically in the industry is a reactive approach to capital investment, and that may often be characterized as an assessment, and as the questioner intimates, assessments are often associated with attrition. So we're big believers in funding the capital needs as the capital expense occurs, which is depreciation, as I said, and a little bit more if you're going to grow your net worth. So we believe in consistent recurring capital dues. The data does show that clubs that institute capital dues, meaning we pay for it as we use it or we pay for it into the future, have less attrition than clubs that have significant assessments. So it's just, it's funny. We fund the operation. It's just the way the industry's grown. It's focused on the operating ledger, and we've decided to pay monthly dues on the operating ledger. But we don't consider it expensive depreciation. All we have to do is take the same philosophy and make sure we generate a commensurate amount of income on an ongoing basis such that we meet that depreciation expense. And I think that will lead to happier members and less attrition over time than if we do it reactively. So assess the needs, determine the amount required, and begin to go at it not in one big bite, but in monthly chunks, just like we do on the operating ledger.
Okay, next question. What do you think is a healthy percentage to run for net PP&E as compared to gross PP&E?
We believe in the wisdom of the crowd, so ultimately all this data we gather reflects the decisions everyone makes. So I can tell you the median is 49, I'm going to say 50%. So believing in the wisdom of the crowd, if your ratio of net PP and gross PP&E is less than 50%, you could say confidently you're more depreciated than the norm. And if it's above, you're less depreciated than the norm. But I do think that the fundamental answer to that question, and I'm not trying to sell, honestly, I'm trying to answer it. I think that you have to be able to say, have we assessed accurately our capital situation via capital reserve study? That is actually the way you answer what the number should be in your club.
Okay, so to increase net worth, should we avoid borrowing money for projects and lean towards capital assessments or dues? I think borrowing is avoiding the inevitable.
Okay, that's a question that we love to talk about here at Club Benchmarking. So a couple of things, and I want to relate it to the 2 questions ago. I didn't actually answer about the return on investment or making an investment that might not pay off. So here's our theory. Our theory is, first, I'll get back and answer it directly, but our theory is that if you make an investment, now there's certain investments you have to make that if you don't make them, you can't draw a line to let's say, members join. Like if you have to replace the HVAC equipment, you're probably not going to get new members join because you replace the HVAC equipment. On the flip side of the coin, if you don't replace it, over time, members will leave, okay, because they'll be too hot sitting in the clubhouse. So, but when you make investments that are done for a reason, typically to generate members, you can work backwards. You can actually say, if the investment was X, let's say it's $3 million, how much capital income, because we believe the return, given the operating ledger's break even, the return on investment in a club is capital income. And if you just say, hey, we got to get a 10% return on investment to take a risk, that means we need $300,000 in that case in capital income. And it's only coming from people joining and paying initiation fees, or members coughing up an equivalent amount of capital income through capital dues or assessments. So the way we suggest that you deal with that is you work backwards. You say, what's our investment? How much capital income do we need at a reasonable level of return or a rational level of return? And then how are we going to generate that capital income? That's the key. And that if clubs begin to do that, it will over time have an effect on the outcome. Now, the question about debt is right on the money, no pun intended, and this is the deal. If the club makes an investment using debt, the net worth does not go up 1 penny. The net worth only, it's not the investment that drives the net worth increase, it's the income that drives the net worth increase. So the capital income's got to be greater than depreciation. If a club makes an investment with debt, there's no income. If it charges capital dues or a capital assessment that reflects that debt somehow, let's say a debt service assessment, then that will have the impact of increasing the income, the capital income. But to be clear, it's the income that increases net worth, not the investment. But to the point of the questioner, the philosophical discussion we like to have here is debt in a club ultimately a reflection of poor capital planning? I'm not going to have the discussion. If anyone ever wants to have it, give me a ring. And I'm not saying there's a right or wrong answer, but that fundamental question, the philosophy behind it is a compelling discussion regarding capital planning in clubs. Theoretically, older clubs that have planned properly wouldn't need that because they would have been accumulating the necessary capital as time went on, and they'd always have the capital they need to meet the investment that's required.
Next question. In an investor-owned club, $9 million in revenue, we've invested $11 million in improvements in a very short time. It will take at least 15 years to pay the debt, and it makes budget incredibly tight month to month, year to year. Balance sheet's insane. We will need a bunch of things in the time before debt is paid. Any genius ideas besides simply focusing on generating more profits, more capital funds somehow?
It's an interesting question. Frankly, I probably have to take it offline, which happy to do. I'd say just generically, it does go back to this point that I made a few minutes ago about return on investment. So we have to make sure that the investments we make do generate a return, and that return has to be through capital income. Although in an investor-owned club, you may be generating an operating surplus, but even if you do, you can't, and I think this is kind of the angle of the question, you can't probably generate enough of an operating surplus to actually make an impact in terms of a return on that investment. So it is about capital income. Once the investment is made, that's where it gets a little tricky, but I think that if the investment's made and and rightly, you've already anticipated you have needs still in the future, the sooner that you address that, the more likely you are to achieve what you need to. Because if you wait, if you're sitting there saying, hey, we got this tight balance sheet, we got this tight income statement because of all the debt, it's true, there's no doubt about that. But if you know you're going to have future capital needs, the longer you wait to generate the income to meet those, the harder it's going to be to meet them. So even in that tight situation, it requires a focus on the capital ledger and determining how much capital income is needed, and then being able to figure out where it's coming from.
Okay, so I think that's it for questions. We will be sending a follow-up. We're going to send a link to the recording after this session, along with some other resources, and the webinar tool saves all your questions, so some of you will be getting back to directly after we end this call. And as always, if you have another question for Ray or for any of us, you can send that to info, I-N-F-O, @clubbenchmarking.com, and we'd be happy to help you.
Thank you, and happy holidays to everyone, and we look forward to seeing you in 2018.